something strange is happening behind closed doors and almost nobody is talking about it. While headlines focus on stock markets and crypto swings, the world's most powerful institutions are quietly hoarding one asset that has survived every empire in history: gold. Some analysts now whisper about a number that sounds impossible: $10,000 per ounce. Not tomorrow, not next year, but closer than most people think. If that sounds crazy? Consider this. Central banks are buying gold at the fastest pace in modern history, even as they publicly promote paper currencies and digital systems. Actions speak louder than press conferences. Welcome to the Gray Ledger, where we follow the money that moves in silence. If you want clear, calm breakdowns of the forces shaping our financial future, take a second to like this video and subscribe so you don't miss what comes next. Because once you see the pattern, it becomes impossible to unsee. And by then, the price may already be far higher. For decades, gold was treated like a relic, something dusty, old-fashioned, even irrelevant in a world of high-frequency trading and digital payments. Central banks sold large portions of their reserves in the 1990s and early 2000s, signaling confidence in the new financial order. But something changed after the global financial crisis. Trust cracked, quietly, but permanently. Since then, institutions like the Federal Reserve have expanded money supply at a scale never seen before, injecting trillions of dollars into the system to stabilize economies. Printing money can solve short-term problems, but it also plants long-term risks. Inflation, currency, devaluation, and loss of purchasing power don't show up overnight. They creep in slowly. Now imagine you are a central bank responsible for protecting your nation's wealth for decades, not quarters. You cannot gamble on optimism alone. That is exactly why countries that publicly praise the dollar system are simultaneously preparing for a world where that system may weaken. Gold becomes insurance, not speculation. In recent years, buyers have included nations that rarely agree on anything else. From emerging economies to global powers, the accumulation trend is strikingly consistent. China, for example, has been steadily increasing its reserves through the People's Bank of China, often reporting purchases months after they occur. Transparency is optional when strategy is long-term. Russia accelerated its buying after sanctions froze portions of its foreign reserves, sending a shockwave through policymakers worldwide. If assets held abroad can be locked overnight, physical gold stored at home suddenly looks very attractive. Even smaller nations are following the same path, diversifying away from currencies they do not control. The message is subtle, but unmistakable. Trust is shifting. According to data compiled by the World Gold Council, central bank purchases have reached levels not seen in over half a century. This is not a coincidence or a temporary trend. It suggests coordinated caution, a quiet preparation for instability that has not fully arrived yet. Think of it as governments buying umbrellas before the storm clouds become visible to everyone else. Meanwhile, global debt continues to climb to historic highs, tracked closely by institutions like the International Monetary Fund. Servicing that debt becomes harder when interest rates rise and growth slows. History shows that heavily indebted systems rarely resolve cleanly. They inflate, restructure, or reset. Gold has one critical advantage in all three scenarios. It carries no counterparty risk, does not depend on a government's promise, a bank's solvency, or a digital network staying online. Independence is exactly what makes it powerful, and exactly why its role expands when uncertainty grows. But the story goes deeper than simple fear or diversification. Central banks are not just reacting to risk, they are positioning for a different monetary future. For most of modern history, the global system has revolved around the US dollar, reinforced by trade, military power, and financial infrastructure. Oil, commodities, and international debt are largely priced in dollars, creating constant global demand. This arrangement gave the United States extraordinary influence, allowing deficits to be financed more easily than any other nation in history. But influence also creates incentives for others to seek alternatives. In recent years, countries within groups like BRICS have openly discussed reducing dependence on the dollar for trade settlements. While progress is uneven, the direction is clear. Gold plays a crucial role in any system that aims to operate outside another country's currency. It is universally recognized, politically neutral, and cannot be printed. Unlike digital reserves or foreign bonds, physical gold stored inside a nation's borders cannot be frozen by external authorities. That lesson became painfully real after Western sanctions targeted Russian assets held abroad. Suddenly, policymakers everywhere had to ask a chilling question: could this happen to us? And if so, how do we prepare quietly without causing panic? One answer is gradual accumulation, buying gold steadily, without dramatic announcements that might move markets or signal distrust. It is strategy, disguised as routine accounting. Another factor is inflation, which erodes savings in slow motion. Even modest inflation compounds over years, quietly transferring wealth from savers to debtors. When central banks hold large amounts of foreign currency reserves, they are effectively exposed to that erosion. Gold, by contrast, has historically preserved purchasing power over long time horizons. Consider how gold behaved after the collapse of the Bretton Woods system in 1971. When the dollar was no longer backed by gold, prices surged dramatically as markets adjusted to a purely fiat world. The decision by Richard Nixon to end dollar convertibility was meant as a temporary measure, yet it permanently reshaped global finance. Temporary policies have a way of becoming permanent when convenient. Since then, money creation has become easier, faster, and larger in scale. During crises, central banks can inject liquidity almost instantly to stabilize markets. But each intervention increases the total supply of currency units chasing the same real goods and assets. Over time, that imbalance pushes prices higher. Gold responds not to headlines, but to purchasing power. When currencies weaken, gold appears to strengthen, even if its real value is simply staying constant. This is why long-term charts often show gold rising during periods of monetary expansion. It is less about speculation and more about mathematics. Central banks understand this better than anyone because they are the ones managing the system. Their buying patterns reflect internal models that the public rarely sees. Another subtle signal comes from repatriation movements where countries request the return of gold stored in foreign vaults. Nations like Germany have moved significant portions of their reserves back home over the past decade. Bringing gold onto domestic soil reduces dependence on foreign custodians during geopolitical tension. It also signals that physical possession matters more than paper claims. Meanwhile, new technologies such as central bank digital currencies are being explored worldwide, promising faster payments and greater control over money flows. Yet even in a digital future, gold remains the ultimate analog asset. If digital systems fail, are hacked, or become politically restricted, a bar of gold still holds value anywhere on Earth. That resilience makes it uniquely suited as a foundation of last resort. Now consider what would actually push gold toward a level as extreme as $10,000 per ounce. It would not require a sudden apocalypse, but rather a series of pressures building at the same time. One trigger could be persistent inflation that refuses to fall back to central bank targets, even after aggressive interest rate hikes. When people lose confidence that prices will stabilize, they begin seeking assets outside the financial system. Another catalyst is sovereign debt stress, where governments struggle to service massive obligations without printing more currency. At that point, policymakers face a painful choice between austerity, default, or inflation. History suggests inflation is often the least politically explosive option, even if it quietly erodes savings. Gold thrives in that environment because it cannot be diluted. Geopolitical fragmentation also plays a role. As trade blocs become more divided, countries stockpile strategic resources, including monetary assets that function during sanctions or conflict. We are already seeing shifts toward bilateral trade agreements that bypass traditional clearing systems. Each step away from a single global currency increases demand for neutral settlement assets. Energy markets are particularly important because oil and gas transactions represent enormous financial flows. If major exporters begin accepting payment in multiple currencies or commodities, the ripple effects could be profound. Organizations like OPEC influence not only energy prices, but also the currency structures surrounding those sales. Even subtle policy adjustments can redirect trillions of dollars over time. Meanwhile, emerging economies with growing populations and rising incomes are accumulating wealth that must be stored somewhere. Domestic financial markets in these countries may not yet be deep enough to absorb it all. Gold offers liquidity, durability, and universal recognition, making it a natural reserve asset during rapid development. This demand layer operates independently of Western investment trends. Market structure adds another dimension. The price most people see is heavily influenced by futures exchanges and paper contracts, where large volumes trade without physical delivery. Institutions like the COMEX allow participants to control significant amounts of gold with relatively small capital, amplifying short-term price movements. If confidence in paper claims weakens, and more participants demand physical metal instead, the available supply for delivery could tighten quickly. Prices in such scenarios can move far beyond traditional valuation models. We saw glimpses of this dynamic during past crises, when premiums for physical gold surged above quoted market prices. That gap reflects real-world scarcity versus financial abstraction. Another overlooked factor is mining supply, which cannot ramp up overnight. Discovering, permitting, and developing new gold mines often takes a decade or more. Even if prices rise sharply, production increases lag behind demand, creating upward pressure. Existing deposits are also becoming harder and more expensive to extract. Environmental regulations, political risks, and declining ore grades all constrain future output. In other words, supply growth is slow, while monetary expansion can be instantaneous. Investment demand from pension funds and sovereign wealth funds could accelerate the trend. These institutions manage trillions of dollars and often adjust allocations gradually, but their moves are enormous in absolute terms. A small shift toward gold across multiple funds could absorb a large portion of annual global production. The market is surprisingly small relative to global financial assets. Psychology matters too. Once prices begin rising rapidly, media attention attracts retail investors, creating feedback loops. Fear of missing out can drive demand far beyond fundamental justification. This is how bubbles form, but in gold's case, the underlying drivers may still be structural rather than purely speculative. People buy not just for profit, but for perceived safety. Even technology companies and financial innovators have started exploring gold-backed products. Blending ancient value storage with modern accessibility, the lines between traditional and digital finance continue to blur. So could gold really reach $10,000? Or is this just dramatic speculation designed to grab attention? The honest answer is that the number itself matters less than the conditions required to get there. For gold to climb that high, it would likely mean currencies have lost significant purchasing power. Not that gold has suddenly become magical. In nominal terms, prices can explode, while real value changes far less. Think of it this way. If a loaf of bread costs $20, $10,000 gold price tells a very different story than if bread still costs $3. Context is everything. Central banks are not predicting exact price targets. They are preparing for uncertainty ranges. Their job is not to maximize profit, but to ensure stability under worst-case scenarios. That is why their actions tend to look slow, boring, and methodical. Quiet accumulation rarely makes headlines, but it can reshape markets over time. Another possibility is a formal revaluation of gold within the monetary system, something that has happened before in history. Governments have occasionally reset gold prices to stabilize balance sheets or restore confidence. Such a move would likely occur during a major financial restructuring, not during normal economic conditions. It would be presented as a solution, not a crisis response. In that scenario, gold would act as an anchor for new rules, giving credibility to currencies that may have been weakened by excessive debt or inflation. The public might not even realize what has changed until afterward. Meanwhile, ordinary investors often focus on short-term price swings, missing the bigger strategic picture. Central banks think in decades, not trading days. Their timelines stretch across political cycles, recessions, and technological shifts. What looks uneventful today may be decisive in hindsight. There is also a psychological comfort in owning something tangible in an increasingly virtual world. As money becomes digits on screens, physical assets gain emotional as well as financial appeal. Gold's weight, permanence, and history create a sense of continuity that digital balances cannot replicate. That perception alone can sustain demand during uncertain times. None of this guarantees a straight path upward. Gold can remain flat or volatile for years before making major moves. Patience is part of the equation. But the underlying forces, debt, geopolitics, monetary expansion, trust, continue to evolve whether markets react immediately or not. Pressure builds silently until it doesn't. If a true tipping point arrives, the repricing could happen far faster than the accumulation phase that preceded it. Markets often move slowly, then suddenly. By the time mainstream headlines declare a new era for gold, early positioning will already be complete. Late entrants typically pay the highest prices. This is why understanding the motivations of central banks matters more than predicting next month's S-chart pattern. Strategy beats noise. At the Gray Ledger, our goal is not to create fear or hype, but clarity. When you understand the incentives of the players with the deepest pockets, the future becomes less mysterious. Whether gold reaches $10,000 or not, the quiet buying spree tells us something important. The guardians of the global financial system are hedging their own creation. And when insiders insure against risk, it may be wise to at least ask why. Questions are the beginning of awareness. If you found this breakdown useful, share your thoughts in the comments below. Do you think gold is heading for a historic surge, or will the current system hold together longer than expected? Your perspective helps shape future discussions, and some of the best insights come from this community. Don't be shy about challenging assumptions. If you know someone who worries about inflation, debt, or the future of money, consider sharing this video with them as well. Information is most powerful when it spreads. And if you want more calm, deeply researched analysis without the noise, make sure you are subscribed so you don't miss what comes next. The story is still unfolding, because the biggest financial shifts rarely announce themselves with alarms. They happen quietly, patiently, until one day everyone wakes up to a world that feels completely different.